This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
All right, everybody. Yes, indeed. We're across Bloomberg platform. What's going on here? Is there a party or something?
There is a
Fed party going on?
There's a Fed party. Michael MacKenzie and Stuart Paul. You get these guys into the studio.
I know.
And we just start partying.
It's like the kegs come out, the Fed talk.
Speaking
No,
of parties,
it doesn't. The kegs do not come
Matt Miller
out. What?
was in here yesterday with you.
He did okay,
I got to catch some of the show.
You know what he said?
What did he say?
It's like, if that Stenovec dude isn't here, just call me.
Oh, I thought he was going to say, hey, that's a hard show. You guys do a lot of work.
He does, yeah. But you know what?
He
comes to play.
Oh, I know. He sounded great.
Yeah, he did pretty.
Not too great, though.
But we missed you.
Okay, well, I'm glad to be back.
We're glad to have you back. All right. And especially as we are counting down to the Fed. We know the Fed kicked off that two-day policy setting meeting. Stocks a little changed, kind of bouncing around a little bit. U.S. yields we've seen moved higher. So we're going to get into that, kind of what's to come maybe in 2026. We've actually got a Fed policy and rate strategy session.
Yeah, we're going to have Michael MacKenzie join us in just a minute. Also, Stuart Paul of Bloomberg Economics. He's here as well. Also, we're going to be speaking with the head of multi-asset solutions at VanEck in just a few minutes about the market implications of everything happening right now, including the policy meeting.
Curious what he has to say about maybe might be his favorite asset class right now. Hey, also we get a read on the economy with Lauren Hochfelder back with us, co-CEO of Morgan Stanley Real Estate Investing. Curious what she is seeing. I looked at a lot of REIT performance, not so great, but certainly rates play into this. So we'll talk with her in just a moment.
All right, and get out the whiteboard, Carol.
Okay.
Because we're going to dive into the financial web behind the hostile bid for Warner Brothers Discovery and what the bidding reveals when it comes to the fledgling cable networks.
There's some incredible deep dives that our Bloomberg News team has done into this. All right, we're going to get to it in just a moment. First up, though, let's get a look at that trade as we await for that Fed decision tomorrow. On it all, Charlie Pell.
Hi, thank you very much. Warner Brothers Discovery, by the way, trading higher again today, up another 2.7%. The Dow lower, the S&P, NASDAQ 100 index trading mixed right now. Right to the numbers here with the S&P 500 index up 4. Little change now, up under 0.1%. Dow Industrials down 121. A drop there of 0.2%. The NASDAQ Composite Index up 53 for NASDAQ, a gain of 0.2%. And the Mag 7 Index up 0.5%. Your 10-year at 4.18% with a 2-year 3.60%. Gold is up $19 the ounce, 42.09. The precious metal now up 0.5%. Major move though for silver. Right now we are looking at silver pushing higher by 4.1%. Brent crude down 0.9%, 61.94 a barrel, and Bitcoin at 93,870. Bitcoin up by 2.8%. Lots of AI news on this Tuesday. Microsoft pledging to invest $17.5 billion on AI and cloud computing in India. Alphabet's Google has been hit by a European investigation over fears it may have abused its dominance by using its own AI tools to squeeze out competition. And Wells Fargo CEO Charlie Scharf says AI poses a significant opportunity to improve efficiencies and has the potential to influence companies' headcount decisions. Recapping, S&P 500 index little changed, up 3 right now, up by under 0.1%. The 10-year ahead of the Fed decision tomorrow, 4.18%. And right now we've got Bitcoin up 2.7%, 93,790 on Bitcoin. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Hey, thanks for that update, Charlie. Appreciate it. As you were doing the news there, some breaking news coming in. The redhead crossing the Bloomberg terminal. The Food and Drug Administration is investigating whether COVID-19 vaccines cause deaths in adults as part of a safety review that's broader than was previously known. The investigation is being conducted across different divisions of the FDA. It earlier appeared to just be focused on children. Numerous studies have shown that COVID vaccines are safe. A spokesperson said, quote, the FDA is doing a thorough investigation across multiple age groups of deaths potentially related to COVID vaccines. Once again, that's a spokesperson in a statement to Bloomberg on Tuesday.
All right. Helps if I push the button. A lot of papers here because I was looking at all of my stuff on the Fed, the eco outlook, and also the bond market. Hey, we do know the Fed has kicked off its two-day meeting, policy setting meeting today. 24 hours from now, we will have had that Fed decision, and we'll be awaiting commentary from Jay Powell, chair of the Fed. A quarter point cut, widely anticipated, expected, largely priced in according to many. But what's next is probably even more important, especially for a Fed that's undergoing changes with more likely to come in the new year. So let's get to it. And I'm curious about how informed the Fed is making their last decision of 2025. With us is Bloomberg Economics U.S. and Canada economist Stuart Paul right here in studio, along with Bloomberg News rates reporter Michael MacKenzie. Stuart, I want to start with you. How informed is the Fed in making this last decision of 2025, considering the lack of data still kind of trickling its way through because of the government shutdown?
Look, I think that the Fed is actually very well informed. We have so much alternative data that if you were really depending on a single jobs report number, you just fundamentally don't understand the economy. I think that I give the Fed enough credit to, and the Fed staff enough credit to think that they have some reasonably strong understanding of underlying economic activity. I think that what's going to be most difficult right now, though, is communicating about the economy when they don't have a lot of the key indicators that we use as common reference points, things like the unemployment rate through October and things like CPI through October. If you're going to say that you're data dependent, but you don't have those specific reference points, it becomes a little bit more difficult. But when we look at the broad swath of economic data, we're looking at dozens of alternative labor market indicators. We're looking at dozens of inflation indicators, and so is the Fed.
Okay, Stuart mentioned some of the indicators that we're looking at if we don't have all of the official indicators that we would typically see and that the Fed would typically see, Michael MacKenzie, ahead of a policy meeting. When you look at all of the data for jobs, for inflation, what do you see?
It's definitely softening, and I think what's problematic about the meeting tomorrow is that the data that the Fed needs doesn't get released until next week. You're going to get November jobs, November CPI. And so the bond market right now has sort of pushed yields up to kind of the highest levels we've seen since late September for both the 10-year and even the 2-year. And they've actually made January, they've sort of taken out the expectations of another cut in January, and they're pretty low expectations for a cut even in March next year. So the idea in the bond market is that the risk is that the Fed could be pretty hawkish. Powell could keep things open-ended, which he's likely to do. And we'll get a cut tomorrow, but the trade is January still going to be a pause, and we'll get an idea of whether January is a pause or is actually in play when we get the data next week.
What's trickiest for the Fed right now? I look at that dual mandate, right, in terms of full employment, price stability. Which one, Stuart, right now is more difficult or presenting more of a challenge for the U.S. Central Bank?
Well, getting inflation back down to the 2% target is the most difficult.
We've been trying for how long now? Like, it's a while.
Yeah, I mean, look, COVID preceded the major inflation push, and inflation peaked at 9%. It's just been a long slog since inflation peaked. And so getting back to the 2% inflation target is the more difficult thing right now. But of course, policymakers are more focused on the labor market. So as much as getting back to the target is the more difficult thing right now, all eyes are on the labor market.
What about the Treasury market and Treasury traders? I feel like the bigger thing, even though we talk so much about the equity market here, I mean, watching what has happened in yields, right? We're above 4%. For a while, I felt like we were talking that 4% was the high, and nope, we're going up there.
What the bond market is telling us a couple of interesting things. If you look at what's happened this year, yields are actually lower across all maturities for this year. And if you dig into the entrails of the bond market and you look at what are real yields, the yields, adjusted for inflation, they're actually lower too. And that's a proxy for growth expectations. So the bond market is kind of leaning in the direction that labor is weakening. We're in a slow fire mode. But bond traders in the back of their minds know that in the past cycles, that's usually tips over into a rapider pace or faster pace of job losses. So the other interesting thing here is that for all the angst about inflation and when is it going to arrive from tariffs or from some other source, inflation expectations, which the Fed used to really lean upon, have remained remarkably stable, and they're steady. and they're actually signaling that over time the Fed will get back towards 2%. So I think what you've got then in turn is you've got some people in the bond market who are listening to some of the more hawkish members in the Fed Reserve, such as Beth Hammack, and saying, wow, they're really worried about inflation. And then they're listening to Christopher Waller, who comes from the sort of point of view that says the Fed should be more preemptive and get ahead of any risk to the economy and cut rates towards what is called neutral, which of course is a theoretical level that neither stimulates or slows the economy. And of course, the bond market thinks neutral's around 3.25. The Fed at the last summary of economic projections put the longer term dot in the dot plot at 3. So that'll be something that people will be watching tomorrow, whether there's any shift in that longer term dot. Because that's the debate. Is the Fed going to get to neutral? Is the Fed actually going to have to go beyond neutral, or can the Fed stop before it gets to neutral? And that's what's going to really determine how we open up the beginning of 2026 and proceed. And then you throw into the mix the potential for a new Fed chair who comes in, and who knows?
Well, okay, so that's exactly where I want to go with Stuart. The who knows part of this. And the idea that, let's say we do in the next few weeks here, that a new Fed chair has been chosen. We don't know what the fate of Jay Powell will be after his term ends. We don't know if he'll stay. We don't know if he'll go. But what does it mean for the last policy meetings where he is chairman?
I think that beyond who's the next Fed chair, the thing that's going to be most interesting is that there are going to be such divergent views on the Fed. You're going to have this new slate of regional bank presidents who are coming in, and they're far more hawkish. So even if you do have a very dovish voice taking a governorship and becoming the next presumed chairman, somebody like Kevin Hassett being announced, confirmed, sworn in, it's going to be difficult for even that dovish potential chairman to build a large enough coalition to deliver really quick cuts. And I think that as long as Chairman Powell is sitting in that role, even if there is somebody who's like a shadow chairman, somebody like Hassett in that governorship spot waiting to take the chairmanship in May, even if you have something like that, Chairman Powell, I think, is going to want to tap the brakes quite a bit in the first half of next year because of his expectation that the next chairman is going to at least try to build a coalition to deliver cuts. It's going to be hard, but I think that Powell is going to want to keep his foot on the brakes a little bit.
15 seconds each. The thing you're watching out from Jay Powell, just quickly, Michael, tomorrow.
I think what everyone's going to be watching is when he talks about the unemployment rate.
Okay. And what?
Because we got very close to 4.5%, and that seems to be a line in the sand for the bond market.
How about for you, Stu?
I think that's probably right. I think that anything about the balance of risks in the labor market tilting toward something like accelerating firing would be really interesting.
All right. We are teed up. Guys, thank you so much. Really appreciate it. Of course, Bloomberg Economics U.S. and Canada economist Stuart Paul, along with our Bloomberg News rates reporter, Michael MacKenzie. We're going to stay on the macro. We're going to now talk about the trade in multi-assets.
And to the head of multi-asset solutions at VanEck Funds, David Schassler joins us. VanEck has approximately $162 billion in assets under management. David joins us right here in New York City. The Fed decision, the commentary, in your view, what's going to affect the financial market trade the most?
We are thematic investors, so I'm going to talk big picture, and then we can kind of narrow it down. So you've got three things happen, right? So think about it this way. You've got three basically mega themes crashing together at the same time, right? First one is clearly disruptive innovation. Yes, we're talking about AI, robotics, everything that, right? But in addition, you've got old world assets building new world, right? None of that happens without infrastructure development, raw assets, real assets. We're in a stealth bull market in real assets. And then third, we're in the debasement era, and that's going to lead to more liquidity. Now we're talking about, I know you guys were talking before this about rate cuts, another 25 basis points, all moving towards and validating the thesis of the debasement era where liquidity is going to get easier out of necessity. So that's where we think we're going, and it completely changes the landscape from an asset allocation perspective.
Okay, so what are you, I just talked to our team and asked them, Michael MacKenzie, Stuart Paul, who watch the U.S. economy, they watch the rates market, kind of what they are queuing up for when it comes to Jay Powell tomorrow. They're going to watch what he says about the U.S. labor market. What is top of mind for you in terms of what could indeed impact the investment environment over the next 6 to 12 months? Or is it too early to even think about that, considering Jay Powell is likely to leave the Fed next year when his term is up and we get some new individuals on the U.S. Central Bank?
Yeah, so listen, Jay Powell, the attack of the central bank, their independence, him getting replaced, all that's happening, right? Who's he going to get replaced with? All that's happening, right? Now, the key is what's going to happen in the markets. AI, let's kind of go back to that because that's what's clearly going to drive markets. That's where the growth is, right? That's the focus. I think about AI in 3 phases. So that's how we frame it up. The first was the build. That's clearly where we spent the last 2 years, where anything attached to AI, billions of dollars in spend, all that was benefited. That's where the scarcity was. That's where the compute was. That's where the energy was. Then we moved to phase 2. Investors are looking at it and saying, well, how do we get paid back? You know, you spend billions of dollars. Well, how do we get ours? And that's when we start asking questions like that, there's going to be a disconnect between hype and expectations and the reality. Make no mistake about it. We're of the camp that AI is going to over deliver and that it's not underhyped long term. But there's going to be a mismatch, and that mismatch is going to cause volatility.
Well, what is the
volatility?
I just want to jump in because the over delivering on AI, I think the concern that a lot of people have is what's the fundamental change then it makes to our economy? The idea that workers should be very worried about their jobs because that's the promise that AI has, an increase in productivity, because this technology can do what human beings do. How do you look at that and the effect of that on the economy and the markets?
I think about it a little bit differently. So there's no doubt that there's going to be replacement, and the next few years are going to be particularly bizarre and uncomfortable for many because where AI can replace, it's already replacing. So you see that in new college graduates. Anybody doing repetitive tasks where they're putting their head down and they're pushing computer keys, be concerned, think about expanding your skill set. At the end of the day, AI, which think about it as the brain, is going to combine with the body, which is robotics, to drive massive innovation, massive productivity gains, ultimately massive growth across the entire labor force. That's the setup. So you end up in a period of an abundance where you get better lives, higher quality of lives, longer lives, all that coming eventually. But the idea is really simple, is that human beings engage with this technology, as we have with every previous technological advancement as it relates to general purpose technologies, to make things better.
Well,
and that's the core assumption here.
So, David, the Mag 7, the Bloomberg Mag 7 total return index up 25% year to date, dropped more than 8% from late October to November 20th, and it's down about 2% since late October. The group has been definitely bouncing around as people question some of the spend by those hyperscalers that make up many of the names within the Mag 7. Is big tech, in your view, a buy, sell, or hold at this point?
It's a hold. And there's going to be more compelling opportunities as volatility is introduced, as people question the spend and the productivity payout. So in a very short period of time, unfortunately, I would say sell, but the reality is I would hold and buy into dips because we're not entering this overexposed from our side. And that's the key, is not being overexposed. This technology cycle has long legs.
Yeah.
It's going to touch lots of things. It's going to require lots of old world assets. There's a stealth bull market going on in real assets right now as well. Natural resource equities are up more than the Qs this year. Yeah. People aren't talking about that.
Well, that's
and how are we going to pay for this?
Well, 30 seconds. You have a favorite asset class. I mean, gold has soared this year. Bitcoin has bounced around. That's kind of the two extremes when you think about kind of the investment environment with a lot of stuff, including private markets and everything in the middle of that. So favorite asset, just got about 25 seconds.
Bitcoin's a top performer by the end of the year, down 30%, mismatched off the Qs by about 50% this year. Followed by gold. Gold will hit $5,000, we think, sometime in 2026. Buy weakness in technology. We're in a long-term innovation cycle.
Cool stuff.
All right,
Fun to
we got
have
some
you.
calls. There it is. We'll have you back.
We will in 2026. David Schassler, head of multi-asset solutions over at VanEck Funds, joining us. That was some cool stuff.
It was. Hey, just real quick, an update on that story. The FDA probes if COVID shots might be linked to deaths of adults. We did see shares of Pfizer and Moderna briefly move lower, but back to now where they were before this report. This is Bloomberg.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got the Dow lower, the S&P, NASDAQ. They are both holding on to gains. S&P 500 erasing most of its earlier advance after a warning from J.P. Morgan Chase on the health of the American consumer. J.P. Morgan Chase shares, they are trading lower today, down now by just about 4.3%. Bottom line here, S&P holding on to a gain of 3 points, up by about 0.1%. Certainly, though, JPM weighing on the Dow. JP Morgan Chase, as I mentioned, lower. Dow Industrials down now by 0.3%, down 141 points. NASDAQ up 52. It is advancing now by about 0.2%. Our Mag 7 index, the Bloomberg Mag 7 index, up by 0.5%. 10-year at 4.18% ahead of tomorrow's Fed decision. The 2-year currently yielding 3.61%. Gold up 0.4, 42.08 the ounce. West Texas Intermediate crude down 1.1% right now, 58.21 a barrel. Cannot ignore the move in silver today. The metal up 4.2%, 60.62 for an ounce of silver. And Bitcoin up 2.9%, 93,940 now on Bitcoin. BioNTech, Moderna, and Pfizer falling as the FDA examines COVID deaths. Right now, BioNTech shares down by 1.1%. Pfizer trading lower by about 0.9%. And briefly, CVS Health is raising its full-year profit forecast and says earnings will rise in 2026. CVS right now up by about 3%. And for on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar along with Tim Stenovec live here at Bloomberg headquarters in New York City. Well, a double dose of kind of the saga and the bidding in the media space continues. We're, of course, talking about Warner Brothers Discovery, the battle for that. It brings us to a story on while Netflix and Paramount Skydance vie for President Trump's blessings in their competing bids for Warner Brothers Discovery. Investors have an irony, Tim, to consider.
The valuation of faltering cable TV networks, we're talking CNN, TNT, and Discovery, among the TV industry's least coveted properties, at least today. It's much of what separates Paramount's hostile takeover bid from Netflix's friendly offer. So here to dig deeper into this is Bloomberg News media reporter Hannah Miller. She joins us here in the studio. I just want to start with the basics here and remind everybody, even though I know they listened and watched yesterday on Bloomberg Businessweek Daily, the Netflix offer and the Paramount offer, they're not apples to apples because Paramount's offer includes the cable networks. Just give us the details there.
Yeah, that's totally correct. So they're different numbers and they're different assets. You know, Paramount wants the whole company. They want all of Warner Brothers Discovery, including those cable channels like CNN. Which
would mean CNN would live alongside CBS, which would be this bizarro world that has never existed before but could exist in the future.
Exactly. Netflix, they just want streaming in studios.
Which makes sense because they don't have those assets right now, so it would be really outside of their core competency to bring in, live TV.
That's right. Yeah, and if Netflix takes it, we'll see the spinoff of Discovery Global. Those would be those cable networks.
Okay, so then it raises the question of what ends up happening to those spinoffs and how are they valued?
Yeah, so that's the huge question here that, shareholders, the board, that's what they're looking at in weighing these two offers. They're trying to determine which one is superior. And the value of those cable networks, that's a key factor in that. And, Paramount is arguing that those cable networks are low, maybe around $1 per share. And, the lower that they want it, the sweeter their deal looks.
Yeah, exactly. I think we're kicking around $4 billion with our own internal Bloomberg intelligence folks. Having said that, I think, Hannah, you want to take a step back, go back 10 years, 20 years. Who would have thunk, right, that the cable industry would be facing such troubles or declining audiences? But here we are. I mean, viewers have a lot of options.
It's true, yeah, and it's very interesting to see this consolidation play out. You would maybe see two news organizations living alongside each other. These struggling cable networks housed under one entity if Paramount gets it. So it'll be very interesting to see how this plays out.
Although you think about NBC or something, right? They moved into a business news channel. They have MSNBC or used to have MSNBC, not anymore. But I'm saying the idea of Paramount having kind of a traditional network and then another cable network, some have thought, they have some digital, I think, offerings, but it doesn't necessarily it's not crazy.
Yeah, I mean, and I think we have to remember here that, the most valuable IP is that movie and studio stuff. We know Paramount is leaning
feeding
really
the beast,
hard.
the content beast.
Yes, and David Ellison really wants to build out that Paramount Plus streaming service.
But I think Carol brings up a really good point, and that's when this is what she was flicking at, this idea that, even traditional media companies that have long had these storied cable assets, they're now trying to figure out what the future of those are. So you have, CNBC and the company or the network formerly known as MSNBC, now MS Now, being spun off into this separate publicly traded entity that Comcast has ownership of called Versant. And, they're trying to figure out, okay, how are we going to value that?
Yeah, and it'll be interesting to see, Versant is supposed to start trading in the new year. And that value, who knows? We'll see if that could play into what's happening with these negotiations.
Good point.
But it's just incredible, right? Content changes, how we get it, and what's coveted and what maybe not so much. Hannah, thanks so much. Really glad we could cover that aspect of the story. Bloomberg News media reporter Hannah Miller. We're going to stay on the battle, though, for Warner Brothers Discovery to a fantastically written deep dive into the hostile takeover bid for the company by Paramount Skydance that is backed by banks, billionaires, and sovereign wealth funds with the goal of torpedoing the deal that Netflix has put out there. So let's get to what is one of the most read stories on the Bloomberg. Sally Bakewell, I can't speak right now. I'm just going to point. Sally's here. She's Bloomberg News America's finance team leader. She's here in studio. The financing that's going in to make this happening, it's quite a list. And there's been some jockeying and maneuvering to kind of get the backing. Walk us through what's been going on behind the scenes.
There sure has been some jockeying and maneuvering. But what we have landed on now is a $54 billion bridge loan, which is coming from Bank of America, Citigroup, and Apollo, who are taking about $18 billion of that each. And there is also a big equity component of about $40.7 billion. Now, there are lots of interesting things to this. First of all, the whole of that equity is guaranteed by Larry Ellison, essentially, who is the Oracle founder, friend of Trump, and father of CEO David Ellison. Now, it's guaranteed by Ellison and by Redbird Capital Partners. And providing the actual equity are this host of names from, the Gulf region, including Saudi Arabia's Public Investment Fund, the Qatar Investment Authority, and an Abu Dhabi relatively new company called Limad, as well as Jared Kushner's affinity partners. So you have this dash of tech wealth. You have this longtime ally of Trump in Larry Ellison as well. You have a spot of family with Jared Kushner. And then you have some Middle East money. And of course, Trump has, fostered some really close ties with the region. So the financing is notable because of the proximity a lot of it has to the president.
This is also a media question, but you brought this up on the call, Carol, when Rupert Murdoch wanted to buy Fox News and the regulatory environment that he had to deal with as a foreigner who was owning a news asset or a broadcasting asset. Maybe it wasn't Fox News per se. Maybe it was the Fox Broadcasting Network. I want to make sure I get that right. And I'm wondering, Sally, and I mean, Hannah, feel free to jump in here too. If there's any sort of question about where this money comes from when it is with regard to owning these assets. Like, we've had cable assets that have had Middle Eastern money before and news assets in the U.S. that have had Middle Eastern money before. But would that mean that CNN could potentially be owned by sovereign wealth funds or partially, rather?
Yeah, and talking about this with folks in the industry, there is this sensitivity around the fact that this is a major news organization at play, that it could be money coming in from abroad. That's definitely something that shareholders are thinking about in looking at these deals.
Go ahead, Sally.
Well, this is the interesting thing about the financing, and some of the tweaking and the reworking of the financing stemmed from this foreign investor component. So they're originally in a proposal that was submitted on December 1st. So that was an earlier proposal. The most recent one was submitted December the 4th. A Chinese company, Tencent, was listed as providing $1 billion of equity. That is no more. And also in the most recent proposal, one of the points that was emphasized was how these Middle East funds they are foregoing governance rights. So they won't have board seats and so on. Apparently, there were no concerns expressed about that element, but I think the company is trying to ward off potential concerns emerging down the line.
What about the president's son-in-law, though? How much of a position is that? I mean, it's hard without getting political, but
didn't the president say yesterday he hadn't talked to him about it, and Jared Kushner is busy working on peace in Gaza?
Yes.
Yeah.
Okay, I just want to make sure.
Yeah, but I mean, okay, how much of that investment? How will he have a board seat? Like, I'm just curious, do we know how much we know about around that particular part of the investment?
I think the idea is that he will also forego these governance rights, i.e. not having a board seat. That is what the proposal said. And it's a kind of interesting playbook that's being developed here with Jared Kushner, because his affinity partners was also part of the consortium that agreed to buy Electronic Arts in September. And apparently he actually brokered the initial connection between the video game maker and the Saudi Arabia PIF, Public Investment Fund, and actually acted as a central figure in the talk. So it seems like he is a sort of pivotal figure in some of these deals.
I see all the names in here and I hear them coming from you, and I think to myself, this is a very complicated deal involving a lot of advisors and a lot of bankers. But is it a complicated deal, or is it a deal of this size would typically have this many moving parts? The debt side, the equity part, and on the equity part, the multiple geographies and the multiple entities?
I think that's a really good question, because what we're trying to now look into is this $54 billion debt package, because the loan, this $54 billion bridge loan, is going to be guaranteed by Paramount's assets. Now, that's apparently quite weird in the market for a loan like this, a bridge loan like this. And a bridge loan is one of these things that you get, and then you bring in other banks to spread the risk. And once the acquisition is announced, after time, the loan is placed in sort of more permanent form of financing, like bonds. And so what we're trying to figure out now, well, the fact that it's backed by Paramount's assets is an effort to get investment grade ratings, as far as we can understand, because Paramount currently does not quite have an investment grade rating. So there's just interesting elements to how this financing is being put together that are definitely a bit striking and a bit unusual, and we're trying to dig into that more.
So more to be known.
Yes.
More to be known. Yeah, I just think it's kind of fascinating. Either of you can weigh in. Is this it, or are we anticipating higher offers or another round? And I'm just curious, Sally, what you guys are hearing.
Ooh, I think I might have to punt that one to Hannah.
Hannah, are you hearing anything?
We know that this may not be a final offer, and they've left that open. Paramount has left that open. Warner Brothers has 10 days to respond, 10 business days.
Okay, so we'll see what happens. We know Comcast is out, though, at least for the moment.
I mean, yes, we heard comments yesterday publicly at a conference.
I mean, I'm not a conspiracy theorist, Carol, but if
you
you're
play
Netflix,
one sometimes
if you're Netflix, like, and you don't get the assets, you want the next bidder to pay as much as possible. Yeah. So it ends up costing them that much more.
Right, exactly. It just there's twists and turns to this one, and I feel like we're not quite done yet. So I know this may go into the new year. Thank you both for helping us understand this as we go, because there's a lot there. Sally Bakewell and, of course, Hannah Miller, we really appreciate it. All right, folks, you are listening and watching Bloomberg Businessweek Daily. More when we come back.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks and bonds wavering. Traders are awaiting the Fed decision tomorrow, 2 o'clock Wall Street time. That's when it drops. 30 minutes later, the press conference, the news conference on Bloomberg Television and Radio. Here's where we stand right now. Little change, as I mentioned, on the S&P, up just 1 point, 68.48 right now, up under 0.1%. The Dow Industrials down 120. JP Morgan Chase weighing on the Dow right now. We've got the Industrials down 0.2%. The Nasdaq Composite Index up 45, up 0.2. The 10-year 4.18%, with the 2-year yielding 3.60%. Gold is up $18 the ounce, 42.09, up 0.4%. A major move higher for silver, up 4.4% right now. Bitcoin up 2.9%, 93,946 on Bitcoin. Briefly, the U.S. Defense Department says it's chosen Alphabet's Gemini for a government system to deliver AI capability for its roughly 3 million civilian and military employees. Alphabet shares up 1.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar along with Tim Stenovec, live here on Bloomberg Businessweek Daily. All right, folks, you got casinos coming to New York City, including one by New York Mets owner Steve Cohen. Also recently on the Bloomberg, you saw the Energy Department planning to unwind a Biden-era program that promoted zero-emissions buildings. And then when it comes to real estate globally, which is something we certainly focus on, a story on a duplex apartment selling, Tim, for a record price in Hong Kong, $113 million US. U.S. in the latest sign of the luxury property sector in the city is bouncing back. But if you talk about China, they still have a real estate problem.
Yeah, they do. That's fair to say. Real estate top of mind for us always, but especially today in our weekly discussion on women, money, and power, where we explore the shifts underway in the world of money and investing and the role women are playing in influencing and investing in those shifts. Back with us is Lauren Hochfelder, co-CEO of Morgan Stanley Real Estate Investing. Got about $54 billion in assets under management. She joins us here in the studio. Welcome back. How are you?
Thank you. Great to see you.
So it's been a couple months since we last spoke to you. If we go back to August, and a lot has happened since then. We've had 2 rate cuts, another one expected tomorrow. Over that time, how has the real estate landscape changed for you?
Yeah. So at this point, we're nearly 4 years into a real estate correction. Since August, I'd say real estate values have really been flatlining. But we look into 2026 and we feel like we're at an inflection point. We've been bouncing around this bottom for quite some time, but it feels like the conditions are on the ground. Sellers are more motivated. Buyers are more interested, right? Debt markets wide open. Lots of things lead us to believe that here we sit, real estate values down 25%. This could be the transition into a recovery period.
Lauren, why haven't people been buying? I mean, I was looking at REITs as a whole. They're down, they're up only about 2.5% as a group. Data center REITs, according to our index, down nearly 16% year to date. Office REITs down about 14% year to date. Malls are up about 4% year to date. I just looked at a few different things. But why is it still, as you say, there seems to be a lot of metrics out there that would be supportive of investors coming in, including depressed pricing. Yeah. Why aren't they?
So, look, I think if you went back 12 months ago, many of these things were true then, right, as we headed into 2025. But what happened is we headed into 2025, we were hit with Liberation Day. And that created a lot of dislocation in the capital markets and, frankly, a lot of dislocation in the occupier markets, because leases tend to be pretty long-term decisions for CEOs, CFOs, et cetera. And what do big decision makers do when hit with a lot of uncertainty? What is my supply chain going to look like, et cetera? They pause. And so you saw a real pause in decision making, which hurt industrial real estate in particular. You saw rents trend down for the first time in a very long time.
You know, we use the term real estate like it's a monolith, but it's not. I mean, there are so many different sectors within real estate, and certainly there are areas of strength. Like at least here in New York City, we know that Class A office buildings, right? If you don't have one of those, you're kind of out of luck. And also data centers to a certain extent in many parts of the countries. What am I leaving off that list? Like, what is the area of strength right now?
Sure. Well, look, to determine what type of real estate is going to perform, you have to look at what human beings need, what infrastructure supports our daily lives. And I'd say living generally, so residential broadly speaking, is necessity-based and it is undersupplied. So as a broad matter, it is a sector we like. But let's get more specific. Look at the population of the U.S. What do we know? We know it's aging. Yeah. Yes. Senior housing is a really high conviction strategy for us. 2026.
You're not the first person to sit in that chair and tell us that, senior housing is high conviction, which leads me to believe that there will be a lot of investment in senior housing. What's the delta between what we need and what we have right now?
Yeah, it is pretty dramatic. Let's look at essentially the 80-plus population is expected to grow by 50% over the next 5 years. So if we even keep penetration rates the same, meaning we only have a small fraction of that senior population in senior housing, we are undersupplied. We are building about half of what we need. We actually think there's a case to be made that penetration rates should increase because, look, it's not only that this is where so much of the population growth is, it's actually where so much of the wealth is concentrated. We know that, right? Over half of this country's wealth is concentrated in this age cohort. So actually, if you look across different residential categories, it tracks as among the most affordable because this is a cohort that, through the combination of home price appreciation, stock market appreciation, et cetera, can afford to pay for this.
Well, that's what I wanted to ask you. When I think about whether it's baby boomers and the whole population that's aging and will need maybe certain types of housing, how much can really afford it? I think we always assume that everybody's going to be able to pay the bill.
Yes.
Is there, I do wonder about the build out. Like, is it too much, because not everybody will be able to afford it, and whether that means they live with kids or something else. I just wonder how much, because this has certainly been an investment play we've talked about for a long time.
Yeah, no, look, it's a profoundly important question, both financially and socially. And I'd say the short answer is, for private pay-oriented assisted living, broadly speaking, yes, it tracks as much more affordable. So for more traditional residential, it's paid for by current income, right? And we obviously are seeing some inflationary pressures, et cetera. Senior housing tends to be more paid for by savings, whether that's distribution, dividends off of your savings, or actual drawdown of assets. So I sell my house and that gives me N number of years to afford senior housing. And the reality is, because you've seen home prices increase so dramatically over the last 30 years that many of these seniors have been in those same homes, they can actually afford it.
But is there an assumption of a number that you guys think about of the aging population, that 50% of them will be able to afford some kind of senior housing? Is it 40%? I'm just curious, because I think we make an assumption that everybody's going to get old is going to be living in, kind of nice assisted living or something. And I don't think that's the case. And I'm just curious about that.
Yeah, no.
It goes back to the overbuild,
Yes, well, I think it's obviously there are different segments of senior housing, different price points. Obviously, the margins are a bit different, so there's a provision of services. But what I would say is, in a way, you have a natural hedge, because there are healthcare provisions needed for this population. And in fact, often staying at home, even if you're living with your children, there is a cost to the healthcare provision there.
Right.
So I think what we're seeing is the adoption of technological innovation, among other things, to bring down the cost of this provision of services that can sometimes be done more efficiently in that format.
We could have an entire discussion on the economics of this. We're seeing it anecdotally. Colleagues who are leaving to actually spend time with their aging parents and take care of aging parents. This is going to hit. Leaving a job,
Like, this is going to hit. Because they're taking their parents in.
Which comes with a financial opportunity cost.
Exactly. The elder millennials and like Gen X really living through this as we speak.
Yeah. It's unbelievable. Thank you for coming in.
Thank you so much.
Yeah, so really interesting. We'll see what 2026 holds for all of us. Happy New Year.
To you as well.
Lauren Hochfelder, she's co-CEO of Morgan Stanley Real Estate Investing, joining us right here in studio. Hey, folks, just a quick update on the trade for you on this Tuesday. As you know, the Fed kicking off its two-day meeting. We've got stocks kind of little changed at this hour.
Yeah, doing nothing, the S&P 500.
Yeah, just down, not even 1 full point. Dow down about 121 points, 0.25% to the downside. And the NASDAQ 100, slight gain, up about 35 points, up about 0.1%.
Healthcare down about 0.5 percentage point. Industrials down 0.3%. Real estate down 0.3%. On the flip side, energy in the green, up 0.8%. Consumer discretionary up 0.3%.
When we come back, a look at stocks on the move when Bloomberg Businessweek Daily continues.
You're listening to Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, coming up on the last hour of trading on this Tuesday, December 9th. Carol Massar, Tim Stenovec, live here at Bloomberg headquarters in New York City.
Is it a Fed Tuesday, Carol? I can call it that.
It is a Fed Tuesday.
Absolutely.
Decision tomorrow, 24 hours from now, man. We will be, we'll know.
If you're on the FOMC, you're working today.
Yeah, you're working today. S&P, though, right now, up a point. You've got the NASDAQ 100 just up about 0.1%, up almost 40 points here. So little moves, but we're waiting to see what the Fed does. And the commentary will be super key.
Mike McKee, he's on the plane to Washington, D.C.
Yep.
Landing soon.
Yep.
He'll be at the press conference tomorrow. Yep. By this time tomorrow, we'll be listening to Jay Powell.
Yeah.
I think he'll be just about done with his speech and taking questions.
Yeah. 2:30 is what he usually, right? Wall Street time.
That's when he starts the speech.
Starts his speech.
So 23 minutes in, 24 minutes in. Yeah, we'll be getting questions now.
I'm looking forward to it. I'm Carol Massar along with Tim Stenovec. Let's get you some stocks on the move in the house. Bloomberg News cross-asset reporter Isabelle Lee. CVS, definitely on the move today.
It's up by more than 3%. So the company raised its full year forecast and said earnings would rise in 2026. So this gives investors hope as the company navigates two things. That's how you can think of it. Number one, a tough retail environment. And number two, government scrutiny across the healthcare industry. We know that a lot of really bad things happened in that industry this year. Adjusted earnings would be as much as $7.20 per share in 2026. And recall that CVS also brought in a new CEO last year and has so far performed really well, with shares rising more than 70% through Monday's close. So this was interesting to me because you always hear anecdotes of how when you go to not only CVS, but any drugstore, and it's not that pleasant of an experience.
Everything's locked up.
Yes. And I feel like when I call someone, I'm almost like, I'm so sorry, sir, can I just please get vitamin C? And I have to read what I'm going to get so that I can just point and not waste his time. But, I mean.
Can I just get deodorant? But it's expensive. I totally get why it's locked up.
CVS is one of the executives from CVS's cybersecurity unit. They don't remember if it was the CTO, was on stage yesterday at this Bloomberg Live event.
Yeah.
And he made the point that CVS is like the last remaining publicly traded large pharmacy company, which got me thinking, you're right. The
other
other
one's
about
Walgreens?
I believe that's the private equity one.
Oh. Yes, they were recently brought.
Yeah.
Oh, they were. That's right.
So it's interesting. That's the world that we live in now. And look, and they're a huge insurer as well.
Yes. And its profit from their pharmacy segment that's projected to grow 1%. So, I mean, I guess everyone needs medicine. You can't not need it.
I'm amazed. That stock's up 76% year to date. Yeah.
Sycamore Partners is the owner of Walgreens.
I forgot that that was late August, right? Yeah. Wasn't it?
I don't know the exact date.
Yeah, I think it was. All right, let's get to, well, where do you want to go next?
Carvana. Ticker is CVNA. Stock is higher by 1.5%. It really just rallied after the S&P said that they will be joining the index by the open of December 22, 2025. So now we're seeing the company stock on track to extend gains for an 11th consecutive session. That's matching a record rally nearly 6 years ago. And Bank of America raised their price target after the inclusion announcement. So as we know, I mean, passive investing is just becoming bigger and bigger and bigger. I mean, if you have a 401k, you have no doubt an S&P or some variation, and this means that you will automatically have Carvana.
It's like a winning ticket, right? Because it's just those guys, all those managers, index fund managers who track the S&P have to buy it up.
Yes, and as of the last close, the stock has more than doubled this year, so maybe we'll see it really go even higher. I mean, Bank of America increased their price target to $455 from $385, saying that the growth trend will just likely be well above average. So good news for Carvana. I feel like I always hear their ad.
Do you have any decliners today?
Sorry, Kara laughed at my joke and that made my day. No, my last stock is also in the green. It's actually up 10%.
What's the deal? On a day where the market's barely moving, you come up with these big stocks in the green, forgetting that it's my job also to figure out some stocks that are moving lower.
I choose to see the bright side.
He's looking for Christmas. He was looking for a name from you. That's basically what it comes down to.
There's a few decliners today.
But Ares is also going to be included in the S&P 500, right?
Yes, and this was a surprise announcement. So the S&P, they have a quarterly rebalance, but sometimes things happen. And so they announced this out of schedule, and it will be included in the S&P before trading opens on December 11th. So also, it's good news, and Ares, like others, have been thrust in the headlines recently, as we know, with the credit market. But their CEO is saying that the collapses we've seen with like First Trust and all that isn't really impacting the market so far. As always, private credit chiefs have been mostly positive when it comes to their asset class. But I don't know, it still remains to be seen. It's a $1.7 trillion direct lending industry, which is ginormous. So there is that. But good news for Ares, up by almost 10%.
Yeah, really some big moves there. I actually think I have that in my gainers list.
Well, look at you.
Look at
I'm glad that Isabelle
and you'll
can
have
do some
it
of
in
the
your
work for you.
401k also.
My 401k.
After December 11th.
Surprise, full transparency. We'll all be owners.
No, Carol's full crypto in her 401k. She's gone
totally
full.
Amazing.
Yeah, she's gone full
I'm still trying.
I love that.
Bitcoin ETF.
I'm still trying to figure out what it is.
Sorry,
Just saying. Isabelle, thank you so much. Isabelle Lee, Bloomberg News cross-asset reporter, joining us here in studio. Check out our Stock Movers podcast. 5-minute episodes of the biggest winners and losers in the stock market. Find it on Apple, Spotify, or anywhere you get your podcasts.
Hey, we got some great programming coming up in just a minute on Bloomberg Businessweek Daily. If you're sticking with us on radio, on YouTube, on Bloomberg Originals, Joyce Wong is going to be by from American Century Investments. And we're going to talk a little ski season later. The founder and CEO of Surefoot. That's all next on Bloomberg Businessweek Daily.